For decades, traders have played the game of arbitraging oil, currencies, and interest rates. But right now, a totally new and frankly much bigger form of arbitrage is quietly reshaping global trade. It's a variable that's hidden in absolutely everything, and it's creating one of the biggest economic opportunities of our lifetime. So let's get into it.
And this quote it nails it. Most companies still see carbon as a chore, a compliance headache, just another cost to manage. But that way of thinking, it's already obsolete. We're talking about a massive shift here, looking at carbon not as a boring cost, but as an active, tradable, and incredibly strategic financial tool.
So, what exactly is carbon arbitrage? Well, it's all about strategically playing the field of carbon pricing, which is, let's face it, all over the place. This isn't about cheating the system, it's about recognizing a simple fact. Carbon now has a price tag, and that price tag is wildly different depending on where you are in the world. And wherever you find a price difference, you find an opportunity.
So you might be asking, okay, but why does this opportunity even exist? And the answer is actually really simple. There is no single global price for carbon. Not even close. What we have instead is this messy patchwork of different rules, different markets, all moving at different speeds. And that fragmentation, that's the fertile ground where carbon arbitrage is born.
Okay, let's make this super concrete. Take a look at this. A ton of carbon that's baked into a piece of steel made in the EU has a completely different cost than the exact same ton of carbon in steel made in China. It's literally the same molecule, right? But it has a different price. And that price gap creates a huge, powerful incentive to get smart.
And look, it's not just a story about Europe and China. This fragmentation is absolutely everywhere. You've got national trading schemes, you've got voluntary markets where prices are all over the map, you've got special rules for certain industries, and you have these new border taxes, like Europe's CBAM, which is basically just a tax on how dirty an imported product is. It's even happening inside countries like the US with different state and federal rules. It's a complex, inconsistent global puzzle. All right, so we've got the why. Now for the fun part, the how. How are companies actually doing this? Well, the smartest ones are already making specific legal plays to use these price differences to their advantage. And these strategies usually fall into three main buckets. And here they are. It really boils down to three things: changing where you make stuff, changing when you invest and emit, and changing who you buy from. Each one of these targets a different piece of that fragmented puzzle we just talked about: the geography, the timing, and the supply chain itself. So, strategy number one is the most obvious one: geography. But listen, this is not your grandfather's offshoring just to find cheap labor. No, this is way smarter. This is about surgically moving the most carbon-heavy parts of your production to places with lower carbon prices, while you keep the cleaner finishing touches in the high-cost markets. It's precision engineering of your global footprint.
All right, strategy two is all about the clock. It's temporal arbitrage. See, carbon prices aren't fixed. They go up and down. And new regulations, they don't just appear overnight. They get phased in. So clever companies can time their moves. Maybe they speed up a green investment to beat a deadline or delay a carbon-heavy project. And that timing alone can save them a fortune. It's about playing the calendar. Now, this third one, this one might just be the biggest, most overlooked opportunity of them all. And it's all about the supply chain. For most companies, the lion's share of their carbon footprint, what they call Scope 3 emissions, doesn't come from their own factories. It comes from their suppliers. So by actively picking suppliers who are just more carbon efficient, you can slash the hidden carbon cost in your own products. It's a huge lever. And this quote just brilliantly sums up why that supply chain piece is so powerful. It all comes down to one thing: information. The companies who get their hands on really detailed, reliable data about their suppliers' emissions, they can make surgical decisions. They can avoid paying for all the embedded carbon that their competitors, who are just guessing with industry averages, are stuck with. Good data literally becomes a weapon. But, and this is a big but, let's be really clear here. This is not some risk-free playground. This is a high-stakes game. Why? Because regulators are getting smarter, the public is paying attention, and the line between smart legal optimization and something that just looks like shady loophole chasing can get very, very thin. You have to be smart about it. So how do the winners play this game? They play it smart. They get ahead of the risks. They fight regulatory backlash by making sure their strategies also result in real, overall emissions going down. They protect their reputation by using rock-solid, auditable data, And as the obvious loopholes start to close, the game shifts to making smaller, smarter micro-optimizations all across the value chain. So, a billion-dollar opportunity? Really? Yeah. And here's why. It's not just about the price of 1 ton of carbon, it's about how carbon is in everything. Think about a global car maker. If they can shave just a few dollars of embedded carbon cost off of every single part, every seat, every tire, every bit of steel, by optimizing their massive supply chain, you multiply that by millions of cars, and suddenly you're talking about hundreds of millions of dollars in value. That's the staggering scale of this. Which brings us to the big picture. This isn't just a temporary trend or some fleeting trick. Carbon arbitrage is a permanent, fundamental shift in how global business is going to work from now on. It's actually becoming a core part of competition itself. And if you want some perspective, think about it like this. For decades, interest rate arbitrage shaped financial markets. Then tax arbitrage completely reshaped globalization. Well, carbon arbitrage is the next big one. It's poised to become one of the defining features of our 21st century economy. It is the new frontier. And that creates a real sense of urgency, right? The companies building these skills today are locking in advantages that are just going to grow and compound over time. But the ones who wait, the ones who keep treating carbon like it's just a problem for the sustainability department, they're going to find themselves stuck with higher costs and thinner margins. It's that simple. So if you remember one thing from all of this, let it be this. Carbon has officially moved out of the sustainability report and into the boardroom. It's got to be a part of how you think about pricing, sourcing, everything. You basically have a choice. Treat it like a passive cost and just pay whatever the world tells you to pay, or treat it like an active strategic variable and shape your own destiny. At the end of the day, that's what it all boils down to. In this new era, the winners aren't going to be the companies with the slickest green marketing campaigns. No. The winners will be the ones who have the data, the strategy, and the guts to navigate this new, complex world of carbon pricing. The ones with the sharpest carbon intelligence. They're the ones who are going to win.